Hey, this call is now being recorded. This is episode 1 of the 435 podcast. Jeff Watkins, how are you, man?
Couldn't be better.
Couldn't be better. This episode is also brought to you by Cup Bop in St. George. If you haven't had Cup Bop, you need to try it. Try the Rockin' Pig.
Yeah, if when we do these episodes, there will be selectively some selective snacks. That's who will be sponsoring the shows.
Hopefully you don't hear the chomping of my mouth.
You can definitely hear it. Makes it even better. What'll be better next time is the pastries. It'll be even better.
I think that'll be good. I think probably having a better camera setup. But we're going to just start with step 1 and go from there and see how that goes.
We're doing it. That's all that matters. We're doing it.
We're going to do it.
So we're wearing the same color t-shirt.
I thought about that.
Yeah.
I think it was planned. I think we were just trying to look cool together.
Well, we are both Capricorns, same age. We plan it, but we don't plan it.
I was gonna have Rage Against the Machine in the background. Just kidding. They won't let us post that stuff. All right. Hey, we're gonna get into it. We're waiting on Brandon Ducharme, Ducharme Financial. He's got to ask Big Brother, the SEC, if he can come on this show. So I was a last minute. Hey, Brandon, I want you to come on the show. He's like, well, I need to get approved because for him to talk about finance stuff, he can't BS it. So he's got to get approved. He'll be on in just a minute. But what we're going to cover today, if you're still with us and didn't lose us at Cup Bop, is the real estate market in St. George, Washington County. And Brandon's going to touch on the financial markets, what happened with the Fed yesterday. The stock market keeps going up. It keeps going up, which doesn't make any sense to me. And I guess I don't know anything, truthfully, right, Jeff? I just don't know anything.
Well, you don't give yourself enough credit.
Well, I appreciate that. Unguided missile, right? As they say.
Unguided missile. Mm-hmm.
All right. Let's see if let's talk to the real estate market. What did you see in the real estate market when the numbers dropped yesterday? What stuck out to you, man?
A few different things. I think the most important thing as far as the market update goes is, the market's down. Market's down quite a bit.
In what way?
45% of what was happening this last January, 2023, 45% of it is down compared to last January.
Yeah, 2022 to 2023. Yeah.
It's crazy.
I'm gonna share this app. Share a tab. Share a window. Share a screen. Let's share the screen. It's dangerous, folks.
Yeah.
You never know what you're gonna find on my screen. I see lots of social media. Oh my gosh, I gotta shut the door. I see on social media all the time market statistics posted by realtors. There are a single image. It's a single image, and it says, this is what's happening in the real estate market, and there's no context, there's no commentary, there's no explanation. It's literally just numbers on a graphic, and it is important. Washington residential listings. It's not a land, lot, and water, right? It's not a multifamily. It's just what is a single family house, right? There's manufactured in here, there's mobile in here, yes, but what is a human living in St. George going to be paying for a house? What are the statistics? What's going on? Okay. So number of listings, look at this arc. Okay. This goes February 22. So it's a 12-month run. Okay. Sold listings, 200 as of January 23rd. Okay. New listings, 499 as of January 23rd. Pending listings. I set a teaser on social media yesterday about a historic January because of that number right there. It's the sold homes in the month of January. Okay, sold listings. These are all the different price points. 198 houses sold versus 350 last year. A 43. You were close, not 45. 43% decline
Big
in
drop.
homes sold. Holy cow, that's historic. I promise you, it's historic because I have every single year since 2011, which truthfully, 2009. Let's look at this. Oh, you guys can't see this. This is 2009, 2008. And if you live in St. George in Washington County and you did then, this will feel familiar. 99 homes sold at the worst real estate market crash in the history of the world. 99 homes sold in the month of January, and we sold 100 homes more. That's wild. Brandon, what do you think about that?
Well, my first thought is that the population of the county is significantly increased since 2009. So you'd hope that there's probably twice as many homes, even physically standing. That's my first thought on it.
Yeah, it's crazy. So if we were to go back, okay, let's go look at 21 and 22, or 21 and 20. 348, 311. Okay. Everybody remembers 2020 as being the hottest market ever. Okay, well, hey, Rob, let's look at Les. What's up, man? Tell me.
I just get, we hear about 20, 21, the COVID years, pre-COVID. Let's take that out. Let's take a look at where the trend was going, 16, 17, 18, 19. Just take out 20, 21. And because let's consider that an anomaly for just a second.
Yeah,
and
it's the
see
blip.
what that trend looks like.
It's the Avengers blimp. It's the Avengers blimp. The blip. Okay. So January 18. Look at January 2018. Here's our number of listings. This was the Trump election. Jeremy Larkin and I did an ad post that if you're moving out of the country, if Trump or Hillary get elected, call us and we'll sell your house. It was the single best Jeremy Larkin ad ever. And he spent $0 promoting it, and I was like, dude, you should have sent this all over the country. So this was like this was a good market. This was a pretty good market, but not anything
it's a healthy
wild.
Market.
It was a pretty healthy market, and we had just come out of the recovery. Like we had finally recovered. Really, 2016 was like a recovery year. Finally, I was going on listing appointments, and people were like, oh, okay, yeah, I paid less than that. When in 2015, I was going on appointments and they're like, I paid more for my house than you're telling me it's worth in 2008. And it's like, almost 10 years later, and they still didn't have the same value as when they paid for it in 2008. That's how big the crash was. It was 48% from peak to trough, 48% the market crash from 2007 to 2012. It's like 2011 was the bottom. Right? So 48% is in decrease. And I'm going to use that as a segue to say, because I'm working on my graphics here. Yep, I use Canva. Look at this. 18.2% our market's pulled back since April of last year.
So if you bought your home in April for $500,000, if you bought your home in April for $500,000, you got a new job, you got to move to Florida, and you need to list it in February of 2023.
Potentially, it's 18% less. Potentially.
You're making the exact case of why people shouldn't hop into real estate without a plan. And this is the case that a lot of financial planners have traditionally had around real estate. I don't think it's flawed either. And that's that if you get into real estate, you don't have a plan, and then you have to move, you have some pretty good risk exposure if you have to sell that house. And now the market's dropped 18%. Don't forget, you're going to take another bath of 6-7% on listing costs, on the cost of sale. So all of a sudden you're way underwater on a home. And but if you come into it with a plan, you understand the rest of your net worth statement, you understand the rest of what's available to you, you understand your cash flow position, you understand your debt position. All of a sudden, if you were that guy, I want to highlight, if you're the guy that bought the home for $500,000, it's now worth $400,000, and you have to move somewhere, but you have a plan now because somebody worked with you to make a smart purchase, and now you can just keep it and turn it into a rental. It really is not that big of a deal, especially in the long term. Right? St. George is still a growing market. There's still demand. You can still rent the right house out.
Yeah, and rates in April of 22 were still like 4 to 5%, right? And so if I bought in April, I probably have an okay interest rate to where rents have increased. They've continued to increase even as the purchase has come down. Rent values have either stabilized or gone up a little bit, right? They haven't gone backwards. And the big reason why, and it's the screaming, it's the governor on stage yesterday at What's Up Down South. Supply. We don't have enough houses. We don't have enough houses. And let me explain real quickly. Okay. This is the inventory. This is the inventory in 2009. We're all the way in a crash at this point. Look at absorption rate, 18 months. We're at like 2 months of inventory, 3 months of inventory right now. Almost 18 months of inventory. Our supply, so insanely out of hand. 2,500 homes versus today. Supply.
Yeah, about
1,200. 1,200.
Mm-hmm. Yeah.
We just don't. Nobody's selling their house, right? The economics 101. And most people listening don't need this, but supply and demand. If there's no supply and a high demand, what is the price going up or is it going down? The price is going up. Brandon was testing me. He's like, I know what that answer is, Robert. Do you know what the answer is?
To see if you walk yourself into a corner here, Robert.
Walk myself. You're like, oh shoot, I said the thing that I'm not supposed to say. So in my mind, going back to what this says, 18.2%, it's significant. Any real estate agent that tells you that that's not significant or that, hey, it's not really a big deal. This is a big deal, dude. That's a big deal. That's a fast change in the market. Never only matched by the market crash. 2% a month.
That's an 18% drawdown on what is 70% of the average person's net worth.
Hey, and Brandon, did I do the math right on 18.2%? I took what it was in April. I got the difference between what it is today, and then I divided that by the original amount. Is that how I'm supposed to do it?
Checks out, man.
Checks out.
The math checks out.
My mouth checks out. Okay. Because
the worst thing for ninth grade next year.
A comment from like somebody super smart. They're like, dude, that's not 18. That's like 7. And I totally missed it. And then I'm like ranting about 18. No, okay, I got it right. I thought this was super interesting. This graph is a little busy. There's a little bit a lot. There's a little bit and a lot to it all at once. What I found shocking about it is that this pink spot is so much smaller in such a short amount of time. Homes under 350,000, which Brandon, maybe you're good at, you're better at doing like the mortgage rate and like how much it would cost. If I bought 350, if I bought a house at 350 and my rate right now is 6%, what's my monthly payment?
Let me pull my model. I'll just punch it in and tell you. Sorry, Excel's firing up. It's not that I'm great at math, Rob. I just know how to use Excel pretty well.
See, yeah.
Give me the parameters again. A home that's 350,000.
350,000, and roughly the APR is 6% right now. Maybe we could get it bought down less than that.
So 6%, and how much down?
It's a first time home buyer. Let's say 5 to 10%. Keep PMI out of it.
5%, not factoring for PMI, which adds, can add quite a bit more.
$200.
Your principal and interest payment is $1,950, which means escrow and your taxes and insurance in there, that becomes what, a 20 factoring no HOA, your PMI, you're probably, you could be as much as $2,600.
Well, and it's so when we look at it from that perspective, is that there's no homes at that price point selling. There's lots of homes over 500,000 selling. So I'm like, well, apparently a lot of people can afford to live here. We're good. But there's a 23% drop in the total homes sold. Who's buying these houses? Is it the first time home buyer? Or is it somebody that's retiring, which is the truth, right? The people that are coming into Washington County are either working remote. They're moving here from another area that they can work remote. Hopefully they get to keep working remote, right? Jeff, we just talked to somebody the other day about how they got to go back to where they came from because they can't work remote anymore, right? Mm-hmm. How long did that last for them? And they bought last year. So that's a pretty quick swing, depending on the businesses that allow us. But, this percentage is shocking to me. I think it's interesting that we continue to drop in total sales. We're down 43% in total homes sold in January. The lowest amount since, I was going, 2012, 164, or 2011, 188. 188 homes sold in 2011. 10 years ago, 12 years ago, the bottom, this is the basement of the market. That's how few people were buying. That's how much demand has been soaked up. Prices are going to continue to come down. There's no question in my mind. Prices are going to continue to come down. There's too much risk for somebody to hold onto a house and try to wait it out and hope demand comes back. In most scenarios, somebody passed away, they got a divorce, they're liquidating everything, they got a job transfer, right? The investors that flipped it, that thought they could buy last year and sell today, right? I heard a talking head, right? Everybody hears a talking head. I heard a talking head saying how, some of these investment companies are basically gonna just let the houses go. They'll take the loss. They'd rather just take the L. If they need to get liquid, if they don't have the assets to cover it. Brandon, what do you think?
On a certain
They'll just sell it for whatever.
As an institutional investor, right, you look at, people have these theories like, oh, BlackRock's coming to buy the whole world up, right? And this whole, own nothing and be happy about it. I mean, there's some validity, I think, to a lot of what people's concerns are over time. But at the same time, BlackRock or these other entities that were buying up homes or stuff, it's still a business. They still need to be producing a meaningful return in the meantime. And if they realize it in hindsight that they overbought, they're going to liquidate as well. They're not going to hold on to bad properties that are not performing, bad properties that are liabilities to them. That doesn't mean they're bad properties either. It just means it's a bad property for their portfolio, right? That's something that you want to make you understand. Just because somebody's selling up an investment property doesn't mean it's a bad investment property. It means it's probably bad for their portfolio, or they have a circumstance that they need to get liquid with something. So it's an interesting perspective, but could we see them liquidate a substantial amount of houses? Yeah, and I think the longer that drawdown goes, becomes more and more likely, right? We see that in the market through what they call margin calls. So yeah. If you're invested on margin and the market starts to deteriorate, they call up and tell you to liquidate your position, or you got to bring more money to the table, right? So it's not much different if you're leveraged into a portfolio of hundreds of real estate residential homes or something like that, and all of a sudden they're going down in value, they're not producing the right cash flow, you owe people money. You might have to restructure your leverage, and all of a sudden that means liquidating some properties. So,
how many of those? At the end of the day, are here in St. George? It's almost impossible to calculate, right? Like we don't know how many as a supply goes. How much of those are going to be like, oh, hey, we just got a bunch of supply that dumped onto the market, and demand still remains low, and now prices they accelerate down. Yeah, because right now we're not accelerating. We're just like, we're kind of rolling down a 2% hill, or it's like 1.8% hill, right? But there's no steep cliff. Where in 08, it was a steep cliff. Foreclosures just went wild, right? We're not there. So it's a rolling market. We're in a rolling shift. How far down do we go? Keep in mind, we're up 75. From 2019 to April 22, we were up 75% in appreciated values. So we're down 18, but we were up 75. So our net gain is pretty high.
Those numbers aren't the same. Just remember, if you take a 75% gain and then a 75% loss, that is not the same end result. That is nowhere near the same end result.
Exactly. We're not getting back to zero.
Yeah, you're not even getting back to break even.
You're not getting back to break even.
You take a 75% loss and then a 75% gain. You're so far underwater still. You don't even. You're probably quitting the game at that point. So
all this to be said, my final point on the market, it's historic. We're definitely in a historic category where nobody has a crystal ball, as much as Jeremy Larkin will tell you. As I walked out of the door to go get my Cup Bop, brought to you by Cup Bop, as I went to go get my Cup Bop, Jeremy Larkin and I started just talking about the market, and he's like, "I've been saying it for 6 months." I'm like, "Yeah, we know your crystal ball works really well, Jeremy. We know, man." But at the same time, if you're watching it on a regular basis, right? If you're watching it weekly, you're watching it monthly, you're going to be able to see these rolls. Okay, this is absorption. This is supply and demand as an index, right? It's in simple terms. How fast are homes selling on the market? We went from 1 month of inventory every single month, right? You're like, oh, 6 months ago. Okay, well, if I go back 6 months, 1, 2, 3, 4, 5, 6 months ago, of course, he saw 1, 2, 3, 4, 5 months of absorption rolling. That's downward pressure on pricing. As absorption rate comes up, that's downward pressure on pricing. You can call the price changes in advance, right? His crystal ball isn't that fancy, but you just got to be paying attention, and you got to hire a real estate team like Wealth 435, me, Jeff Watkins, Brandon Ducharme, to do your real estate plan, to give you a strategy. Get with agents that know what you're talking about. There's my pitch. Hire us. Tell your friends. We'd love your business, especially right now because only 100 homes sold last month. No, 198 sold last month. And yeah, there's the real estate market update for you. We're finally in depreciating territory, people, over 12 months. That's it. That's all I got. We're depreciating over 12 months. Brandon, tell us what happened with the Fed yesterday.
They did exactly what the market thought they were going to do. So Powell,
they got crystal balls.
Well, either that or Powell's capitulating to the market and what their expectations are because he doesn't want to further spook. In the past, over this past year, all it took was him getting up and making a remark. If you look at like the August rally that happened, and he just got up and said, I don't know why the market's rallying. There's further pain ahead. We got to continue to raise rates. And the market rolled right over immediately, and we saw a new cyclical low. Coming off of what everyone thought was a great rally that had been we had seen the bottom in June, and we're, starting the new bull. And it took one commentary from him. So I think we're still in fragile territory with what the Fed is doing. And, all I can be certain of is that they're going to raise rates. They're going to keep them the same, or they're going to lower them. And, anything beyond that, you're talking about a forecast, and there's a phrase that we use in the tactical money management world, which is forecasts are for show and tactical signals are for dough. So, if you want to make money, you want to follow the tactical signals, you want to follow the data. You don't want to make decisions based on what you think the Fed is going to do, because ultimately Jay Powell could wake up one day on the wrong side of the bed, make a comment that collapses the market, or they decide to drop rates, and all of a sudden home prices are soaring again. So how do you do that? How do you really navigate a real estate decision like this? It's an illiquid asset. So I'm a market timing guy when it comes to liquid assets, but when you're talking about an illiquid asset, it really does become time in the market, not timing the market, right? And so if you have a good plan put together, you are managing your risks, you're making smart decisions based on a holistic approach. A depreciating market could be a wonderful opportunity to buy into, right? Because even if home prices deteriorate and depreciate the next 2 or 3 months, it could be the end of this year, and the Fed drops
12 months maybe,
and all of a sudden, the homes shoot up in value, right? If you have one, you capture that. If you're sitting on the sidelines waiting to try to catch a bottom, that's what we call in investing catching a falling knife. And not too many people can catch a falling knife successfully, and it's also a really risky activity. So if somebody's considering getting invested in real estate, what they ought to do is sit down, make a good plan, and understand what's available to them, and understand what can help them meet long-term objectives, given a set of parameters, and then also understanding the risk in the market. And if it plays out one way, what happens to your goals and meeting your goals? And if it plays out another way, how does that affect your ability to attain your goals? And if that sort of risk is okay with you, then timing the market's probably going to do you better than timing the market on an illiquid asset like real estate.
So outside of real estate, right? Because I think the one thing that I like to drive home is that when we sat down and decided that, hey, we were going to have a real estate business that was a little bit different, we said, okay, how do we be a place where somebody can go and say, hey, I'm interested in investments, period. Right. I'm interested in investments. So real estate, that's I'm a certified ninja when it comes to real estate in Washington County. To some markets, maybe not so much, right? But for sure, you're going to be hard pressed to find somebody better than me that understands or knows our market better. What are you a ninja in, Brandon? Like, if I'm looking at the markets, stock indexes, commodities, treasuries, currencies, like, what are you a ninja in, man?
Well, first off, you're giving me a little bit of a spook with the term ninja, because I was paying enough attention in 2008 when everyone had the no income, no jobs, no asset loans. And I don't want to necessarily be associated with that type of situation. That's what caused 2008. But a
ninja?
Yeah, the ninja loans. You ever heard of the ninja?
Oh, I didn't even know. See, look at that. There you go.
No income, no job, no assets, no job or assets, right? Ninja loans. There's the state income loans that kind of built up to 2008. I specialize in risk management. That's really the key. Okay. I manage liquid assets, right? I do retirement planning. I do the planning with people, but then I also manage the liquid assets, and that's a skill set that I bring to the team that's really valuable here. And if you look to those liquid assets, typically with the market, when people refer to the market, they typically mean the stock market or the bond market. There's a lot of healthy internals in the market right now that are showing strength. But at the same time, there's some that are concerning, and it's not necessarily time to go risk on. Again, you don't want to try to catch a falling knife. So what I do is help my clients navigate the risk of the market and the volatility of the market by being able to manage a portfolio that pivots between risk on and risk off, and can be invested, but it can just as easily be in cash or money market accounts. And right now, I mean, there's stuff out there in short-term bonds, short-term treasuries even, that's making 4 or 5%. And it's really like a cash equivalent. So there's opportunity to be had out there, but what you want to do is always manage the risk. And that's just like I do it in the market for clients' liquid assets. If you have a good plan in place, I help our clients manage the risk of their overall wealth as a wealth manager. So that way, when we're making decisions, again, in real estate, it's a risk managed decision that makes sense, that helps them. We can clearly see how it helps them work towards meeting their goals and objectives. And they understand how, hey, if it plays out good, this is what the result is. If it doesn't play out, here's what the result is. And is that risk that they're okay with. And, you don't want to take a risk that destroys your ability to reach your goals over time.
I got a question. So I'm presenting again. I'm presenting, everybody. Watch out. I'm presenting. I pulled up the CNBC. This jumps out to me. This jumps out to me because first thing that jumps out to me is that the real estate sector is up 5 points.
Why?
2% change, right? Because we just covered why there's no reason why that people are like, hey, real estate we're doing, things are going fine. There's no fire right behind us. This house isn't on fire. The market's not literally getting obliterated, right? So that's the first thing that jumps out. But what jumps out to me is that when you look at all these financial sectors, and I think of like, hey, why would it be rallying? Meta's up 23% today. Like how can 67% technology sector, isn't this just floating? This to me looks like a huge bubble. And I don't know what Khan's disk is. What's Khan's disk? I'm clicking on it.
Yeah.
Consumer discretionary sector.
You're looking at a list of spider funds. That's really what you're looking at.
These are spider
well,
bugs because this says the sector watch. So I don't like I said, I don't know anything about this, right? But
if I could give you any commentary on Facebook, though, by the way, while we're on the topic,
I love it. I love it. Give me your 2 cents on Facebook.
Okay. If you look at the chart on it, it's what's called a gap up, right? So it closed yesterday at about $152.
Here you go.
Right? And it opened the market today at $182. So there's a gap of about $30 that happened overnight, right, in the price action. And in the technical world, in the pros, they look at gaps, and gaps that are created are gaps that are closed. The market is likely, I'm not saying always, but the market is likely to come back and close that gap, meaning that within a reasonable time frame, we are likely to see Facebook trading below that closing price again of $152. So it had a swing up today, but markets don't just swing up like that out of nowhere. That's not a healthy, stable market, right? That's a huge amount of volatility, and when you see that volatility on the upside, it comes back, and it comes back even more ferocious on the downside. So again, you guys are highlighting some concern in the real estate market, but really what I'm saying is you might be highlighting some opportunity in the real estate market. We might be highlighting some opportunity to take a portfolio that has been risk on because it was a buy and hold type scenario, and you might look to start transitioning that to risk off. Well, you can, and that's what we call, not looking to buy the dip, but we're looking to sell the rip. So just consider that with Facebook.
Sorry, it cut out for me. Looking to not buy the dip, but sell the what?
Sell the rip. It's ripping to the upside. It really shouldn't be. It's a sucker's rally in all likelihood. So
this is crazy though, man. Sell
it to someone else that's willing to buy it right now, right? I mean,
you posted a video like you get on Robinhood and you buy something and you don't realize that somebody's selling on the other end, and that person selling is like an expert. And I was like, dude, that resonated with me. I was like, I should not be playing this game. It's like going and playing blackjack with an expert, right? You're just like, why are you even a blackjack's probably not the best example. Poker, maybe, right? It's significantly
harder than playing blackjack against an expert. At least there's just, odds and statistics in that.
It's an expert
4 o'clock. Knows something you don't know.
At 4 o'clock, it's at $153, and by 4:15, it's $180. 420, it's $180.
At least their earnings.
This is insane to me. Why did it shoot like that?
Look, I'm not a big single stock guy.
Son of a bee. I got the wrong. I'm barking up the wrong tree.
Stocks, but go look at Meta. They likely released their earnings after market close yesterday.
That's probably what they did.
Probably a good earnings report. It was more than the market expected, and so people hopped in. The futures contracts went up on it during market close, and so when it opened up today, it opened up roughly 20% ahead of where it had closed.
That's a crazy day, dude.
You're spot on, Brandon. It was they released their earnings yesterday.
See, I didn't even have to look it up to tell you that was probably the case.
Well, so
but you know what Facebook did last year? It rolled over and lost more than it lost more than 20% in one day last year. So
exactly. Like that's the point, right?
Here's the thing: is you can be scared because you're letting emotion drive the bus, or you can have tactical signals that look at the technicals and they make decisions based upon predefined rules, and those predefined rules is what manages the risk. Okay, so you want to make emotional decisions in this market, I promise you're going to lose. You will lose. There's too much emotion, too much volatility, too much at risk, too much in play. There's newsprints coming out every week. It's good, it's bad, it's good, it's bad. It could be better this time. Oh, it was worse. Oh, it was better than expected. How does somebody, that is so much emotion for somebody to handle, especially when you're talking about what's likely your life savings. It's too much emotion. You have to have a rules-based approach. And
rules-based approach. I like that.
Rules-based
approach. That's a great way to end this. We're 45 minutes in. If you're still watching, I'm Robert McFarland, Brandon Ducharme, Jeff Watkins. We're Wealth 435. We're gonna keep doing this. This is the 435 podcast. We're gonna keep giving you updates on what's going on in the market. And we're going to keep getting better. We'll always have some. No, we may not have sponsors, but
Mountain Dew, if you're listening, I'm here for you.
Mountain Dew, call me up. Give me a contract. My one takeaway is, if you do need to sell, hire a real estate agent that understands where we're at in the market and where we're headed, and how a pricing strategy and a good marketing strategy is going to maximize the amount of money you're going to make. Because the second you say, I'm going to try to use a butter knife when I need a chainsaw by selling your house as a for sale by owner, or asking the agent that you know that does it part-time and also works down the street at the grocery store, hire a real estate agent that does this full-time so they can make you the most money. I promise you the commissions and what it might quote unquote cost you is not going to match. You don't want to give the money to the buyer. If you're a buyer, hire a great real estate agent that takes advantage of the agents that aren't negotiating the best on the behalf of their clients. Okay. Because on the flip side, there's a lot of houses on the market right now that can get beat up. And if the market's going this way, you want to be buying ahead of where the market. You don't want to buy where the market's at. You want to buy ahead of the market if you can. Get a real estate agent who knows how to negotiate and find a good deal for you. That's me. That's Brandon. That's Jeff Watkins. Brandon, what's your one takeaway?
Have a plan, get good advice, objective opinions that look at your situation holistically and integrate a plan that you understand, and you understand why and how it fits your plan. That's decision-making territory. If you're unclear,
stick with them.
If you're unclear, you're getting sold.
Jeff, what do you got, man? What's your takeaway?
Yeah, very, very similar, man. There were agents, back in July and August that were, that meme with the dog sitting in the kitchen that's just burning.
Yeah, that's everything's fine.
Everything is fine. Yeah, buy now. I would hate to have been a buyer, back in July or August, that was kind of unclear, and just took the advice of my real estate agent: buy now, when in fact you didn't have to. And I know there's different situations for different people, but everyone has a different situation. But I think the key is to have a plan, take the advice of people that know what they're doing, and do it on a daily basis, and execute.
Okay, guys, we're Wealth 435. Check us out on social media: Facebook, Instagram, LinkedIn. I'm Robert McFarland. We'll see you out there.